the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Dan Passarelli. Before we get started, we have a short disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. We believe hypothetical computer-simulated trades are accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this disclaimer is at the bottom of all of our web pages if you'd like to read it in full. So with that, I will turn the ball over to you. And while I'm doing so, just welcome, Dan. This is the first time you've been with us, and actually the first time we've really spoken to each other. So it's nice to meet you. I've seen Market Taker for a long time and seen you on different things, CBOE, and it's nice to finally get to meet you. So welcome.
Yeah, likewise. Good to meet you finally as well, Tom, and I really appreciate you inviting me. Thank you very much.
Oh, anytime.
All right. So shall I share my screen and get going?
Absolutely. You should be able to now.
Okay. All right, let me just do this, and there we go, and here we are. We're off to the races.
Yep, I see it loading. Okay, I see how time spreads can profit from volatility with limited risk.
All right. Well, welcome, everyone. Thanks for attending this webinar. I really appreciate it. Once again, my name is Dan Passarelli, and we have this presentation today. It's going to talk, of course, about how time spreads can profit from volatility with limited risk. Go figure. I like to make these rather interactive presentations, and so if you have any questions, please feel free to ask. Tom, will you just read the questions to me, or will I be able to see those? Or
either way, you should be able to see them in the chat, but I can also read them to you if you like.
Yeah, maybe you read them just because I'm a little clunky with this. So yeah, if you see one pop up, if you feel like it's apropos, feel free to just interrupt or something.
Okay, will do.
Okay. All right. So before we get started, everyone, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading, and you can get a copy of that by calling 1-888-OPTIONS. That's the home of the Options Clearing Corporation here in Chicago. All right. So Tom says you guys are an intermediate to advanced group, so I presume that you know functionally just what a time spread is. You buy one option, probably a call, and then sell another option, would be a call as well. You can do both puts if you'd like. But typically retail traders, that's what your broker calls you, trade long time spreads. That means you're buying the longer term expiration cycle and selling the shorter term expiration cycle. For example, buying the March 40 calls, selling the Feb 40 calls, right? And of course, I presume that you're rather familiar with this concept as well. This is a sort of makeshift profit and loss diagram of a time spread. Most you can lose is what you pay for a time spread. If it goes down too much, that's what you lose. If it goes up too much, you'll lose pretty darn close to what you paid for it. And you want it to be at the shared strike price at expiration for your ideal situation. Of course, you probably won't hold the trade until expiration. I can give you my feelings on that a little later during the Q&A section. But as long as the stock is near that shared strike price, near expiration, you're in pretty darn good shape. These profit and loss diagrams, of course, are not actually accurate, right? Because they express the profit and loss at the expiration of the shorter term option, the expiring option. And at that time, you'd still be long an option that probably has some time premium that's dictated by volatility. And we don't know what the volatility would be at the time of the shorter term options expiration. We don't know what the long-term options volatility will be, so we couldn't possibly know what the spread would be worth at any given price. unless, of course, there's a very big move down or a very big move up. Therefore, this is just sort of an artist's rendition. Even if you log into your brokerage platform, of course, they will give you projections of your maximum profit and projections of your break even, but those are still just projections. All right. So that stuff, I presume everybody knows. Volatility, I got a sneaking suspicion that you guys probably know the definitions of this stuff. But my guess is that there's some people in this audience who maybe don't use volatility as much as maybe they should. And actually, I think I'm going to see if I can pull up the chat here. Oh, I can. Look at that. So, Tom, I'll be able to see the chat, so I guess I don't need to rely on you to read questions. That's okay. Better this way. Yeah. Okay, so here's what I'm going to do, guys. I want to take sort of a little bit of a makeshift poll or survey, if you will, and I want to see how many people currently use volatility in their trading. So give me a Y for yes or an N for no. Just go down to where it says chat and give me a Y. Yes, I do use volatility in analyzing my option positions in my trading. Or N, nope, I never even think about it. Okay.
We've had one no and all the rest yes. Most of us are using Option View, Option Explorer, Thinkorswim, things like that, so we're pretty familiar.
Yeah, okay, good. All right, good. So just quick recap for I guess it looks like a couple people said no by now, and you guys can see this too, right? Quick recap. Realized volatility, forget the definitions I have on the screen here. Realized volatility is just how much the underlying stock has moved around recently, right? Stated in terms of annualized standard deviation. Implied volatility is, forget this definition on the screen, it's how cheap or expensive options are, right? Okay, so that being said, we can now talk a little bit about term structure. Term structure is the observation that options with the same strike price but in different expiration months can have different implied volatilities. Now, this becomes really important when it comes to time spreads because you're trading options with the same strike price but in different expiration series. And so they're very, very likely to have different volatilities. Okay, so now I think everybody's on the same page. We caught up the newbies. Now I think I'm speaking to everybody here. When every once in a while, I'll come across, some article written by somebody on time spreads or something. I don't really attend a lot of presentations by other people or anything like that. But a lot of times when I see time spreads being taught, what they teach is basically what I just took 30 seconds to run through. The max loss, the max gain, the break evens, the makeshift P&L diagram, and here you go trade. Go look for a neutral stock and put on a time spread. Good luck. See you later. But that is a very, very superficial way to look at time spreads. Time spreads, though they're sort of one of the building blocks of more advanced option strategies, they're much more complex than they let on. Volatility is at the absolute heart of trading time spreads. And using volatility to trade time spreads is really, really essential. Basically what you want to do with time spreads is only put on a time spread when the longer term option has a lower volatility than the shorter term option. You're buying the cheap one and selling the expensive one. So the deal with that is that is your number one single most important filter, okay? If you're looking at a time spread and you look at the term structure volatility and the front expiration has a lower volatility than the back expiration, don't trade the time spread. Who can tell me why? Why wouldn't I trade a time spread if the front expiration volatility is lower than the back expiration?
I don't see it.
Yeah, okay. Well, all right then. How about this?
Yeah, paying more for time. There you go. From Thomas.
Yeah, I mean, kind of, Thomas. It has a lot to do with, well, those of you guys who are using volatility in your analysis, what are you using your volatility for? Like, what are you doing with it? Like, the reason you use volatility analyzing options is because whenever you're selling options, you're selling volatility. Whenever you're buying options, you're buying volatility. So therefore, you only sell options when they're expensive, right? Like, you only, like, forget about option trading for a second. You only buy things when they're cheap, right? You only sell things when they're expensive. Like, that's like the number one sort of rule of business. It's common sense. Like, my kid sets up a lemonade stand. He knows, you know, hey, I buy the lemonade, you know, ingredients for cheap, and I sell it for more than I paid for it. Well, that's what it's like with option trading, but what measures whether options are cheap or expensive is volatility. So let's see here. George is saying low IV can lead to high IV in front month, and back month will not move to catch up. You know what? I think some of you guys are not on the right page here. Here's what I'm going to do. I'm going to pull up, what do I need here? Whoops. I'm going to pull up my account here. I had to find the right one. There it is. Oops. Oh, I'll get it eventually. There we go. That was painstaking.
Got it.
Yeah, there we go. Okay, so look, let's look at, drug. I don't like doing this on drug companies. That's it. Yeah. All right. So let's take a look at just a regular old option chain. We'll look at the SPY. And, oh, look, we're pretty much, okay, well, hold on. Andy says, buy cheap, sell expensive for time spread may or may not work. When front vol is high and back is lower, there's a good reason. There can be a good reason for it. Yeah, so this is, you're pointing out like one of the biggest misconceptions of volatility there is, Andy. And I'm glad that you brought that up because this requires some explaining here. So look, what is volatility? What is implied volatility? Some people will say implied volatility is the market's consensus for future volatility. Is that accurate? There's only one right answer. Who's brave? Is implied volatility the market's consensus for future volatility? Is that an accurate statement? Okay, good. Jules is correct. Robert, I'll get to, I'm kind of on my own schedule here, babe, so I might get some of those, but I might not. All right? So Jules says, no, that's correct. Jules has the right answer. It's not the market's consensus estimate for future volatility. The market is not a single thing. The market is sort of this, the market is made up of everybody, including everybody here in this room, right? So it's not like everybody sort of gets together and, everybody who's part of the market gets together and sits in a room and votes, oh, well, what should we make implied volatility? It's a function of people buying and selling options. Now, you guys are, kind of a more elite set of traders, as I understand it from what Tom explained to me. You're more advanced. Most of you guys look at volatility. Some of you guys maybe do a great job with it. Some of you guys are still working at it. But a lot of people don't even look at volatility when they trade. And you know what they do? They create noise in the options market. Okay? Like, look, if somebody has a newsletter out there, and there's a bunch of people who subscribe to newsletters, personally, that's not something that I advise. I think people ought to sort of do their own homework, maybe get some ideas from newsletters. But there are plenty of people out there who subscribe to newsletters, and some of these newsletters have a ton of subscribers. And sometimes the guy who runs the newsletter says, hey, you should buy these calls because I think the stock's going up. And you know what happens? 1,000 people go out and buy 5 lots. So there's 1,000 5-lot orders going in there. And you know what that does? It bids up the price of the implied volatility. Now, none of these people who are newsletter subscribers look at volatility. They just do what they're told. And you know what they do? They force up the implied volatility for no good reason. They're not buying or selling based on assumptions about implied volatility. What they're doing is they're just buying a call because they think the stock's going up, real rudimentary. And there's a lot of people out there doing this. I imagine you guys who are experienced would be surprised, at how many people actually do this. Like, I'm sure you don't do this. And who is this? Martell says it isn't everybody. You're right, it isn't everybody. But guess what? You guys are in the minority. Like, good traders are in the minority, A lot of people do this, man. And there's a lot of noise in the options market. So implied volatility is not what a professor would call an efficient market, okay? It's seldom priced correctly. Now, somebody earlier pointed out, well, if implied volatility is high, it's high for a reason. I'm going to throw one word in there to make that statement accurate. If implied volatility is high, it might be high for a reason, but it might not. And it's seldom exactly correct. When you back out the implied, like in an earnings event, somebody mentioned a binary event like earnings. In an earnings event, if you back out the implied volatility and you look for the standard deviation to predict the move that's going to happen, that's expected, quote unquote, to happen, it's almost never right on the money exactly what it is. The options are either too expensive or too cheap. And it could be either. It's not ever universally exactly one or the other. It's not always too expensive or always too cheap. So that means there's always opportunities to get an edge in the market. Like, look, that's what you're doing. I imagine that most of you guys are income traders, right? So, with income trading, what you're doing is you're selling volatility. There's some people out there who don't look at the volatility, but they heard that income trading is great, and so what they do is they go and they put on iron condors and credit spreads month after month after month, week after week after week, in the weeklies, if you will, and a lot of times they put them on at a disadvantage. Like, you only put on income trades when the implied volatility is high because you're selling option premium. Now, time spreads become much more complicated. Time spreads have a positive vega, so it appears that you're buying volatility, but really you're not, are you? Because the front expiration volatility is more volatile, if you will. It moves more. So what you're really doing when you put on a time spread is you want to buy a fairly valued back expiration option and sell an overpriced front expiration option. And you want one of two things to happen. You either want A, the implied volatility of the front month to come down and match the volatility of the back month. Like, never are you expecting the back month to rise to get up to the front month. Like, the market mechanics don't work that way. The front month volatility or the front expiration volatility is the one that does the moving typically. It moves a lot more than the back expirations. So A, you're looking for that front expiration to come down and meet the back expiration. Let's talk about that before I get to B. Now, if there's an event like earnings or something like that, yes, the front expiration volatility is going to be really high, and I'm not advising that you put on a time spread if earnings is coming out tomorrow. What I am advising is you look for those needles in the haystack. You look for what professional traders call edge. You look for the situations where implied volatility is a little bit high in the front expiration, 2 to 20 points. But there is no news out. There is no earnings. There is no, big deal Fed announcement. There is no reason that you can find for the front volatility to be above the back volatility. And you've got to look hard, but you're going to find those every single day. You go through enough charts, volatility charts, you go through enough option chains and look at the term structure, you will find candidates like this every day where the front expiration volatility is high, but there's no reason for it. That's what I'm talking about. You need to take this a thought iteration step further than maybe some of you do. Don't just say, oh, this number's bigger than this number, do it. No. That's how you run into trouble, because that's when, oh, well, earnings is coming out. Oh, well, there's a lawsuit expected to be settled later in the week. Yeah, take it a thought iteration further. Look for a stock that's not moving much on a chart, a stock that's in a channel. Look for a favorable term structure volatility where you can buy the cheap back month, sell the expensive front expiration, could be a front month or could be a weekly, and go through the news and make sure that there's not news expected. So therefore, that's an artificially inflated implied volatility that's waiting for you to go there and sell it. Take advantage of all the newsletter lemmings, who bid up volatility for no reason because they don't know what they're doing trading options. There's hundreds of them. Like you guys have heard people say, well, 95% of traders fail. That's right. You guys who have been successful, who are intermediate to advanced traders who have been trading for a few years and actually made money, you don't know it, but you're in the 5%, man. Like there's tons of people who get into options, they lose their behinds, and then they leave, and then they're replaced by new people. Like those are the 95%. Take advantage of them. Be selfish, be a predator. Look for the high implied volatility that these lemmings bid up to give you the gift of edge. All right? Now, I'll take a couple of questions here, but I still have B. There's still like another part to this that you're going to love. Thomas says, so is one way to evaluate IV to examine open interest? No, those are absolutely two different concepts. There are some analyses that you can do that might use both, but open interest could be high. But if open interest is high, that could be because people have bought a bunch of options, forcing implied volatility higher, or it could be because people sold a bunch of options, forcing implied volatility lower. So no, I'm talking about something different. Now, don't get me wrong. We might go through this conversation, and open interest may come into one way of understanding some specific niche that we're talking about, but they're two very different concepts. Here's what you need to do when it comes to volatility. Volatility chart. There we go. Like the simplest, most basic, most rudimentary volatility analysis is just looking at 1 month, not looking at the term structure. And you're looking for two things. You're looking at what implied volatility is relative to itself, and you're looking to see what implied volatility is relative to historical volatility. We can see this in this chart right here, right? This is the spiders, okay? The implied volatility is a little under 12 here. It is specifically 11.7. Now look, it's kind of been in a decline here for the last 4 weeks. In fact, it's in the bottom half, it's in the bottom third of the 6-month period we're looking at. So relative to itself, implied volatility in SPY is low. Relative to historical volatility, implied volatility in SPY is low. Right now, implied volatility in the spiders is cheap. If you're putting on income trades in the spiders, you might make money. They're high probability trades. You know, you sell them, you can figure out, you know, using delta and all that business, what your probability of success is. Your chances of making money is great because they're high probability trades, but you're putting them on for negative edge.
Hey, Dan, one of the questions was term structure. Would you select all of the IVs and deselect the HV, and you can show them the term structure?
Oh, yeah, sure. Why not? We'll deselect the HV.
Right, and select all the other IVs, exactly.
Yeah.
Because I was just on the call with one of our institutional clients, because the term structure is actually over a 2 standard deviation steepness, because he was telling me how cheap, okay, the longer term options were on the SPY, and you can see right here that it is not. If you take a look at what the implied volatility is of even if you even hit the 360-day,
yeah,
you'll see it even be right. It becomes even steeper. So what we're looking right exactly. Okay. So what I just got off the phone. Okay, arguing with somebody's options expert for one of our institutional clients. He was saying, oh, the implied volatility is at 11. Okay, look at how low it is. Why aren't you buying leaps? Now, what term structures, just because the 30-day, right, yeah, I know, it's funny too, right? But believe me, do you know how much I had to bite my tongue not to call this guy an idiot, okay, on the phone? Okay, just because the implied volatility of the front month, if you take a look at that, that's very, very low. Now, that's how much the 30-day implied volatility is. Mm-hmm. But if you take a look at how the distance between the 30-day and the 360-day, that light yellow line at the very, very top, that's pretty far apart. So just because, the 30-day is low doesn't mean that the 360, because he wanted us to buy leaps. I mean, it's totally different. Now, also, all term structure is how much is the 30-day option, the 60-day option, the 90-day option. And the reason why you need a tool like Thinkorswim or some other professional tool is that you can't really look at what the March is versus the, let's say, the Novembers or the Decembers, because those days keep changing. You need to have to compare apples to apples. So what they do is that they normalize the 30-day IV all the time, and they normalize the 60-day volatility. So this way, this chart actually makes sense.
Well, let me jump back into what I was talking about, because so I don't run out of time, though, all right?
So I'm sorry.
No problem. So anyway, guys, the moral to the story is this is a horrible time to do time spreads in SPY. It's just a horrendous time to do time spreads in SPY. You're putting them on for what is referred to as negative edge. Now, let me run through a couple other questions here. So Andy says, on liquid stocks, wouldn't IV be artificially inflated when big players are trading, not 95% of rookies? Well, I mean, look, it's both, okay? In trading, it goes back and forth. Sometimes it's about 40% of the volume is professionals and 60% is retail. Sometimes it's 40% retail and 60% pros. It flip-flops. It's about half, okay? And look, I've been on all ends of the options business. I've been a market maker down on the trading floor, so I was the guy who was sort of the mechanism of volatilities. I won't say market makers set volatilities. They react to order flow to change volatilities. The market is what really sets volatilities. But I've been teaching for a long time, and I teach retail traders like people in this room, but I also teach professionals. And guess what? Just because somebody is a professional trader doesn't mean they're an options genius. I once taught a class at the SIBO for a group of money managers, and at breakfast, it was one of the first classes I ever taught. And there was this guy who managed, I think it was $2 billion of money, and it was one of the first classes I ever taught. And I was thinking, geez, I'm looking at my presentation, and it was on covered calls. It was on just this basic, it was the most basic presentation of anything. And all the slides, there was 3 hours of this basic, here's Mr. Call, here's Mr. Put, here's what a covered call is. And so I'm talking to this guy at breakfast, and he's got this big job at this big bank managing, again, $2 billion. I was really nervous because I figured this guy's going to eat me for lunch because I'm teaching such a basic presentation, but I can't change it. That's what I'm supposed to teach. After the class was over, this guy came up to me and he said, "Oh my God, this class changed my life. I learned so much. Wow, I had no idea you could sell calls. This is amazing." So some of the professionals who are trading, whose votes count much more than most people in this room who are trading 5 lots or 10 lots or 50 lots. Some of these guys are not necessarily options pros either. They're buying puts for protection because that's all they know how to do. Or they're selling covered calls to generate income because that's all they know how to do. And they're not even looking at volatility, some of them. So the market for volatility is completely inefficient. You want to read about that, pick up my book, The Market Taker's Edge. Buy it on Amazon. Don't buy it for me. It's cheaper on Amazon. They got some deal with my publisher. They can sell it cheaper than I can. I talk a lot about the inefficiencies of volatility and the sort of symbiotic relationship of the market makers and everybody else, the market takers. So yeah, even very, very liquid stocks, implied volatility can be artificially inflated or artificially depressed also. Michael says, trading the big indices will be quite hard with that criteria. Not at all. Look, I just showed you that you would never even think about putting on a time spread in SPY today. Now, if we go back and look at what we were looking at, well, there were plenty of times where, there were a few times where time spreads would have been great, but a lot of times time spreads wouldn't be great. So, I mean, look, this is a criteria that is essential for selecting the binary answer. Do I trade a time spread? Do I not trade a time spread? Jerry says, what's your definition of term structure? Term structure is just simply the observation that volatilities in different expiration cycles are different. Like, for example, look, these March 6th 212 calls have implied volatility of 9.4. These March 20th expiration 212 calls have a different volatility. It's 11.1. That's term structure. This is sort of inverted term structure, This is you wouldn't do a time spread here because you'd be selling the cheap and buying the expensive. That's what term structure means. I use the Skew chart too, Jerry. What's this? This guy Jerry is saying perception versus real, level of skill and experience versus OPM money, other people's money. I don't know what you're talking about. Yeah, okay. I don't know what you're talking about, man. All right. Anyway, let's keep focused here. Okay. Thomas says, so essentially you want to do a time spread when you have positive skew. How about this, Thomas? I'll answer that even more generally. I want to make a trade when I have edge. I want to make a trade when it is statistically in my to my advantage. So yes, I only want to do a time spread when I have positive skew. ML says, is the artificial inflation deflation caused by market pressure or market maker discretion? Great question. It's market pressure. So I was a market maker down on the floor of the CBOE for many, 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 many years. So on the one hand, yeah, I changed my volatilities, and that made the bids and offers lower. Yes, these bids and offers on the screens here, they're shown by market makers. They're a function of the implied volatility set in the market makers' models. But I didn't just sit there and say, ho hum, well, I guess I'm going to change my volatility. Or I didn't say, oh, geez, I wish volatility was higher. I guess I'll just make it higher and raise my volatility. Because then you know what would happen? The smart money here, not the people who I'm saying create noise in the market, but Goldman Sachs and the smart traders, they come in and say, oh, look, this guy just raised his volatility. The bid's too high, I'm going to sell it. And then I'd end up buying more options than I can handle. So it is the market that forces market makers to change their volatility. I mean, look at these March 13th 212 calls. They're 143 bid. Okay, so there's a market maker somewhere in the world. You know, the market's closed now, but there's a market maker somewhere in the world who's saying, hey, I'd buy these at 143. So he sets his volatility in such a way that he is displaying a 143 bid. If Goldman Sachs comes in and sells 1,000 calls and, you know, I buy my shares worth, I buy 200 of these calls, well, now I got a bunch of time decay. I've got a bunch of vega. You know, I'm going to obviously hedge them to get delta neutral, but I've got to spread off my risk. So I don't want to buy anymore at that same volatility level. I lower my volatility so that I lower my bid. Goldman, in this imaginary example, forced me to lower my volatility. Market makers just react to order flow, guys. Thomas says, is positive skew as important if you're doing weeklies? Now, there's a great question, Thomas. It's not quite as important because the vegas are so small with weeklies. We can get back to that shortly. Okay, I like the way you're thinking. Ren says, what about the vega differential? Doesn't the back month always have a higher vega? Yes, but the back month implied volatility doesn't move as much. So in an ideal situation, what you really want to do when you're looking at a volatility chart, in a perfect situation, what you really want to see is, see this light blue line? You want to see the exact opposite of this. This light blue line here is the historical volatility. That's between the 30-day and 60-day. Oh, wait. Oh, no, I clicked the wrong one. Okay. You want to see basically the opposite of this. I've got the 30-day implied and the 120-day implied. What you really want to see is the 30-day implied above historical and then the longer-term volatility below historical. That's ideal because then you're buying cheap options that are underpriced, selling expensive options that are overpriced. But you're not always going to find that. Even though the back month option, and see, this becomes really important. Who's asking that? Ron. This becomes really important, and this is what tricks even intermediate, even sometimes advanced traders. Sometimes they don't really understand the vega differential and how volatility actually works. Even though when you buy a time spread, your net vega is going to be positive. And here, let me just show you how that works here, guys. Like, if I buy these April 212 calls, I get a 31 vega. And then if I sell these, you know, March 212 calls, I've got a 17 vega, you know. So I get long 14 vegas if I put on this time spread. So it looks like I have positive vega, and technically I do have positive vega. But you know what I want to have happen? I want volatility to fall. But specifically, I want volatility to fall in the front month. All right? Now, before I get to more questions, I want to tell you something. Remember, I told you I want one of two things to happen, scenario A or scenario B. Scenario A is just like I said, I want to sell that high inflated vol in the front and watch it come down to the back month. Guess what? That's not always going to happen. There have been times in individual stocks and as well as the broad market where implied volatility has been overpriced for 6 months, 9 months, longer sometimes. It doesn't have to come down. Just because it's irrational, just because the market is giving you a gift of free money, doesn't mean the market's going to change. And that's okay. You know why? Because what does implied volatility, what does it mean if implied volatility is high? If implied volatility is high, you know what it means? It means option prices are high, right? So that's not a big stretch. I mean, anybody who's ever read anything about volatility gets what I just said, right? If implied volatility is high, that means option prices are high. Simple, straightforward. But there's something that we can derive from there that's extremely helpful to you time spread traders. if option prices are high, do you know what else is high? Theta, right? Because look, these February 27th expiration, 212 calls, they have a 10.9 implied volatility. They're worth 45 cents if we look at the bid, and their Vega is 14 cents. Now, we know what, the theta rather, is 14 cents. Now, guess what? We all know what theta means, right? That means that tomorrow, if the spiders don't change in value at all, then these will go from 45 cents to 14 cents less, to 31 cents, right? They're out of the money. It's all time premium. So guess what? What if implied volatility was higher? What if it wasn't 11? What if it was 22? Well, then these would be worth about double, roughly. We could do the math with Vega, but no need to get fancy. If these were worth 90 cents because implied volatility was higher, well, guess what? By February 27th, by expiration, they still have to be worth 0. So their theta would double. So that's really what you want to see. That's really the whole big secret to this recipe. You want implied volatility to be higher in the front month because you're getting more theta. You're getting free theta. You're getting more theta than you deserve, which is great. That's what trading's all about. It's about getting edge. It's about beating the market, outsmarting the market. Like, look, man, I've been teaching options for a long time. This is Market Taker's 7th year in business. We've put over 2,000 students through our program. And you know what? I talk to income traders all the time, and they say, oh, you know what? I need some help because I thought I knew what I was doing with income trades because I made money for 12 months in a row, and then 1 month it erased all the profits that I made over the last 12 months. You know, you hear stories like this all the time with novice income traders. That's because they're looking at income trades as extremely superficially. They're looking at it just as, oh, well, look, the delta's 20, so that means I have an 80% chance of success, so it's a great trade. Well, no. You've got to look at what your payout is. And there's different ways of looking at that. There's risk to reward, but the real payout is theta, which is a function of implied volatility. So, I mean, this is how you make money trading time spreads. Okay, let's get back to a couple questions here. Andy says, Dan, according to you, who exactly is the smart money that would cause the implied volatility to be efficient? Well, okay, so yeah, let's talk about that. So, I mean, the smart money are experienced traders who really understand how options work, okay? They're the people who use volatility and really look at it, and they only buy options when volatility is underpriced, and they only sell options when volatility is overpriced. So there's a lot of smart money out there, but not enough to make up for the dumb money, not enough to make the market efficient. They more like say the implied volatility should be 15, but it's really 20. Well, the smart money steps in, and that's when they start selling. That's when they start selling options. They put on their credit spreads. They put on maybe their time spreads if there's a volatility skew. But they probably don't push volatility back down to 15 and make it strong form efficient. There can still be plenty of margin for error. And, you know, who these guys are, I don't know. I mean, there may be some of you guys in the room here who are like, who know exactly what I'm talking about. Like, yeah, that's what I do. You know, maybe some of you guys are the smart money. You know, people like Goldman Sachs and JP Morgan, let me tell you something, they're the smart money. You know, I was down on the trading floor. I saw if volatilities were out of whack, those were the guys who were coming in to sell it or to buy it. Marcel says weighted Vega. I don't know what you mean. ML says, so without software like LiveVol, are we trading blind? Without some sort of software that enables you to see the term structure volatility or to see volatility charts, Yeah, I mean, you're definitely trading blind if you're not using volatility software, obviously. I mean, volatility is at the heart of option trading. So, I mean, I think LiveVol is great. I think they've got the, some of the best, most accurate analytics in the business. But hey, there's other, I mean, any option-friendly trading platform is going to give you volatility figures. So if you have a broker who doesn't give you the term structure volatility, who doesn't let you put a column in your option chain that says IV, or who doesn't give you volatility charts, then you're trading blind and you need a new broker. And probably they charge you too much for commissions because they don't want option traders. Because they, that's why they're not giving you the tools to succeed, because they don't want you as a customer. Time spreads include double diagonals and calendars. Yeah, Thomas. Yeah, I mean, time spreads and calendars are synonymous. The time spreads definitely include double calendars. Everything I said in regard to our conversation here about time spreads also holds true for double time spreads, for double calendars. When it comes to diagonals, they get a little bit trickier. I don't want to open up that can of worms. It's a little out of scope of what we're talking about, but the vertical skew tends to gum up the works and it gets a little bit trickier. Thomas says, so the key is knowing how to determine what is fair volatility. Yeah, I mean, look, like volatility arbitrage traders and market makers, like when I was on the trading floor, like I would know this is what fair volatility is right now. I would have an exact number. What you need to do is not necessarily know what fair volatility is, but know relatively if it's cheap or expensive. Martel says it wasn't a question. Oh, it wasn't a question to me. Oh, I see. Okay. All right. I was wondering what you're talking about. Andy says, Dan, what do you think about Thinkorswim as compared to LiveVol for vol analysis? Look, Thinkorswim is one of the best platforms out there as well, guys. I mean, Thinkorswim's a great one. LiveVol's a great one. If you need a platform for volatility analysis, I've got a guy over at LiveVol. I'll hook you up with him. He takes good care of my customers. He'll walk you through the platform, maybe give you a discount on commissions. Email me.
Dan, by the way, what we end up having is that if clients or anybody in our community clicks through, we've already negotiated that they'll get a 10-cent discount, a 5 cents or 10-cent discount off of the LiveVol price.
Oh, is that okay? Great, good. So you don't need me. Great, perfect. But yeah, I think LiveVol is great. I think Thinkorswim's great too, guys. Let's see here. Marat, hope I pronounced that correctly. Is there an edge in trading a time spread on vertical vol differential across strikes? For example, buy at the money time spread and sell an out of the money time spread. Well, you're just, no.
That's a box.
Yeah, you're just putting on, yeah, you're putting, well, it's a jelly roll. You're putting on just a.
Yeah, I'm sorry, yes.
Yeah, you're putting on like basically an interest rate play then. Thomas says, I've had big problems with diagonals and I think this is one reason why. Yeah, I'm sure it is. Oh, that was Thomas. Jim says, we also think LiveVol has the best Greek analytics in the business. Yeah.
Yeah, the only problem we had, by the way, our community had with Thinkorswim was sometimes on the cash-settled indexes, the in-the-money, Greeks, didn't end up taking into consideration that the dividend gets paid into the index, where LiveVol actually takes care of that. And so you have a much better, if anybody uses deep in the money like calls to offset risk and things, which a lot of our traders do, the LiveVol, ends up doing a much better job of calculating those Greeks properly.
All right, so listen, guys, this is great. I'm going to take some more questions in a second. Everybody, you're all on your computers. Open up a browser in a different window. Go to markettaker.com/GC2. Okay, markettaker.com/GC2. We have a class. It's called the Market Taker Live Advantage Group Coaching Class. The fact of the matter is finding option trades is time consuming, you know, like any bozo can just go and put on an iron condor week after week, but sometimes you're selling, you know, underpriced options and it's a crappy edge trade. We're going to give you 10 actionable option trades that have edge in it in every single class. And they're mostly spreads, obviously. Every once in a while, you know, there might be a breakout where we say, hey, you know, this is just buy a call is how you get the most bang for your buck. But obviously, they're typically spreads, mostly income trades, of course. These classes are every day at 9 a.m. Central Time. East Coast guys, it's 10 a.m. your time. And it lasts an hour. It's a live class. We set up, it's actually go-to meeting, kind of like we're doing here. It's a webinar formatted type class. And you listen to our head coach, John Kamisic, and he shows you trade setups every day. These classes are all recorded, so if you miss one, no problem. Some of our students sign up for this class. They never watch it live. They just watch it recorded. So look, this is, I mean, if you can imagine, you're getting, you know, several trade ideas every single morning. You know, we charge $997 a quarter because, well, frankly, if you make money on 2 of the trades, you know, in the first week, it covers the cost of the class and everything else is gravy after that. But we've started doing this recently. We don't want you to take our word for it. We're going to give you a 2-week trial for $97. So you can sign up for this by going to markettaker.com/GC, pay $97. You know, I mean, that's nothing. That's your that's most of you guys' commission for the month or something like that, right? Pay $97. You're in the class for 2 weeks. Evaluate it. If you like it, stay. If you don't, it actually renews at a discount. You never pay the $997 a quarter price tag. It renews at $227 a month. So you're saving like almost 25%. So please try it out. Take me up on this. Oh yeah, Randy did us the favor of typing it in the chat here so you guys can just copy and paste that into your browser. Does anybody have any, I'm going to answer some more questions, of course, here, but does anybody have any questions specifically about this class before I move on and get back to the option trading? Does anybody have any questions about this $97 trial price? Oh, I guess Andy asked, do you mainly teach only time spreads? No, you know, because, I mean, look, there's sometimes when time spreads are really great trades because you can get a lot of edge, but then there's sometimes when they're not quite as good trades. So, you know, we talk about time spreads when time spreads are good, but, you know, sometimes there's other things that are good. And we like to mix it up. I mean, I've never in my entire life met anybody who makes a trading career out of trading only one strategy. You know, everybody in this classroom, like if we were all in a room, I could say the beginning of this trader's idiom and you can finish it, right? It works until it, what? It works until it doesn't work, right? So yeah, I mean, clearly we don't just stick with one particular strategy, not time spreads, not anything. Let's see here. Andy says, what other strategies do you teach? Do you also trade them for yourself? We teach, in the class, we teach, and when you say teach, it's both teaching and it is, it's giving you the ideas. It's kind of earn while you learn. So what we do is we let the market tell us what to do, right? Like, you know, if it's bullish stock, we have a positive delta position. If it's a expensive volatility, we have a negative vega position. If there's volatility term structure skew, we have a time spread, you know, so we trade everything. My motto is give me an EKG chart, I'll trade it. You know, we trade everything. We trade all the stocks, we trade all the indexes, all the ETFs, all the strategies. That's what we do. Andy says, you also trade them for yourself. Yeah, I mean, John teaches the class, and sometimes I take John's trades. Hey, man, I've been doing this for over 20 years, wrote a couple of books on options. You know, I'm on TV being interviewed by Bloomberg and Fox Business News and all that. But you know what? Sometimes I just take John's trade ideas. So yeah, I do trade them sometimes. Okay, let's see here. Ron says is implied usually overstated relative to historical. Well, no, I mean, sometimes it is and sometimes it isn't. He says, meaning it's tough to find implied below historical. Well, no, I mean, the chart we were just looking at, SPY, has implied below historical, right? So, like, I think, some of the questions, and I assume some of the questions are from, like, maybe some of the newer traders, which is awesome. Like, use this opportunity to learn and to get better. Like, the biggest mistake I see novice traders make is, they think that, like, there's this one thing that always works. Like, there's this one best way of doing things. Like, I can just keep repeating the same thing week after week or month after month. That might work for a year. I mean, geez, if you were selling put spreads on the SPX, I mean, that worked for 2 years. But guess what? It's not really working anymore, is it? Or at least not as easily. They're not as good. So there's nothing that's always this, or usually this even. Trading is about looking for opportunity, and I think some traders don't dig deep enough. They don't follow through with enough of the research to actually find the trades that do have actual real edge to them, So, no, implied is not usually overstated relative to historical or understated. Sometimes it's one way, sometimes it's the other way, and that dictates what you trade. And that dictates what strategies we give out in our class, I mean, hey man, if volatility is, at bargain basement discounts and all the options are as cheap as they get, I'm sorry, I can't in good conscience give you a whole bunch of credit spread trades. It's not going to work, They might have a better than not chance of working out, but they're statistically unsound. That means that in the long run, if you do that 100 times over, you're a loser in the long run. And that's not what trading's about. It's not about getting that one winner because I got an 80% chance of winning. It's about, hey, I'm going to make, 10,000 trades over the next 10 years. So I need to have a plan and not just rely on, hey, I know this is high probability. I want to care more about edge than just the one-off, hey, look, this one should probably work, All right. Well, I guess that's it. If anybody... Sorry, go ahead.
Oh, just say I think we're out of questions, and we really appreciate you coming here, Dan.
I appreciate you inviting me. Thank you, and I hope that you guys found this informative and useful.
I think it was very, very useful for a lot of our users. One of the things that I'll end up doing, because some of the questions were a little bit more basic than maybe we had seen in terms of term structure, people just don't know the terms. We run trading groups. I run a trading group. Normally it would have been at this time. We pushed it back to 6:15 Eastern. So that's in a little less than an hour. For anybody who wants to end up signing back on to the trading group, I'll show you the live vol tool, how not only there's a difference in implied volatility from month to month to month that we call term structure, but also in strikes either below or above the money, which is called skew. I'll show you how the live vol tool ends up working, and I think it probably does. As for a free tool to come with the broker platform, I think it's amazing that you can get this stuff for free these days. We used to end up paying thousands of dollars for information like this.
All right. Well, thanks everyone. Thanks for. I did cover all my slides, I think. Oh, by the way, if you take this trial, you'll also get my ebook, Intro to Credit Spreads. John actually wrote that one. We sell that for $29, but we're going to give it to you for free today. So, I mean, hey guys, look, if you're traders, you're used to, paying some money, taking a chance at something working out. Here, this is probably less than you've ever paid in margin on any one of your trades. It's $97. And my guess is the long-term upside is probably a whole lot better than any trade you could ever make. So once again, markettaker.com/GC2, and I'm Dan Passarelli. Follow me on Twitter, twitter.com/market_taker.
Dan, thank you so much.
All right. Thanks for having me.
Thanks, everyone.